Taxing the fine print. Why your capital gains might still cost you. Welcome back, listeners, to another deep dive into the stories shaping our financial world. Today we are unpacking a topic that sparked quite a bit of chatter on social media and beyond: the new income tax rebate in India under the much-discussed new tax regime. The headline sounds fantastic: no tax on income up to 12 lakh rupees. But as a viral post by a chartered accountant recently pointed out, there's a catch when it comes to capital gains. So let's break this down together and figure out why some taxpayers are still seeing a tax bill despite staying under that magic 12 lakh threshold. First, let's set the stage. The Indian government, as part of its push to simplify taxation, introduced a new tax regime that's been grabbing attention since its rollout. Under this system, taxpayers can enjoy a rebate under Section 87A of the Income Tax Act, which effectively means no tax liability on income up to 12 lakh rupees. With a standard deduction of 75,000 rupees factored in, this can even stretch to a gross income of 12.75 lakh. That's a significant relief for salaried individuals and others with regular income, especially for middle-class earners who've long felt the pinch of rising costs. Finance Minister Nirmala Sitharaman herself emphasized this in her Budget 2025 speech on February 1st, framing it as a breather for those earning up to 1 lakh rupees a month. Sounds like a win, right? But here's where the confusion creeps in, and it's a big one. Not all income is created equal in the eyes of the taxman. While your salary or business income might qualify for this zero tax benefit, capital gains, those profits you make from selling assets like stocks, property or gold, play by a different set of rules. A chartered accountant recently took to social media to highlight this discrepancy with a real-world example that's got people talking. Picture this: a client with a salary of 10.75 lakh rupees and an additional 1.10 lakh from capital gains. Their total income is 11.85 lakh, well under the 12 lakh threshold. And yet, they're staring at a tax bill of about 22,000 rupees. How does that add up? The answer lies in the fine print. Capital gains don't qualify for the Section 87A rebate. Let's dig into why this is the case. Capital gains, whether short-term or long-term, are taxed at special rates, not the progressive slab rates that apply to your regular income. For instance, short-term capital gains on equities are taxed at 20%, while long-term gains on the same are at 12.5%, provided you've held the asset for over a year. For property, the holding period for long-term status is 24 months. These rates are fixed, and the rebate that wipes out tax liability for regular income doesn't extend to these gains. As Rajarshi Dasgupta, an executive director at AccuLaw, explained, the tax system treats capital gains as a separate beast. Even if your total income looks like it's under the no tax limit, the portion from selling assets will still attract a tax bite. Now you might be wondering why this distinction exists. It comes down to the philosophy behind taxation. Capital gains are often seen as windfalls or investment returns, not the hard-earned wages of day-to-day work. Governments worldwide, including India, tend to tax such income differently to balance revenue needs with economic incentives. In this case, the Union Budget 2025 explicitly clarified that the Section 87A rebate applies only to non-special rate income, meaning salary, business profits and the like, but not capital gains. It's a deliberate policy choice, but one that's clearly caught many off guard, especially smaller investors or those new to navigating the tax maze. So why does this matter to you? Well, if you're someone dabbling in stocks, real estate or other assets, this is a wake-up call to plan your taxes carefully. That profit from selling shares or a piece of land might push you into taxable territory, even if your day job income seems safely under the rebate limit. It's a reminder that the no tax up to 12 lakh promise isn't a blanket one. It comes with asterisks that can cost you if you're not paying attention. And with more Indians investing in markets than ever before, thanks to accessible trading apps and a booming equity culture, this misunderstanding could affect a growing number of people. As I wrap up today's episode, I can't help but think this story is less about a policy flaw and more about a communication gap. The new tax regime's benefits are real, but the nuances, like the exclusion of capital gains from rebates, need clearer messaging. For now, my advice is simple. If you've got mixed income sources, don't assume you're in the clear just because the numbers add up to less than 12 lakh. Consult a tax professional, crunch the numbers and stay informed. After all, in the world of taxes, the devil is always in the details. Thanks for tuning in, folks. Let's keep the conversation going. Until next time, take care and keep questioning.